I'm Meg Johnson. I'm the broker for Lux Realty, and today I am here with Thomas Hogan at Ameris Bank, and we're going to be talking about the construction perm loan that Thomas has to offer for home buyers who are interested in building their home from the ground up. So thanks for having me, Thomas.
Thanks for having me.
And I jotted down a couple of questions to ask you about.
Sure.
One of the things, first, to start off, can you explain what the construction perm loan is and how it differs from a traditional home loan?
Yeah, that's a good place to start. The construction perm loan is best explained by telling you the old way people used to build houses. It used to be that you would go into a bank and obtain a construction loan to build a house, and when that construction project was over, you would go to a mortgage company and take out a mortgage to refinance that construction loan into a permanent loan. About, I don't know, at this point probably 15 or 20 years ago or so, Fannie Mae and Freddie Mac got wise to that process and began working with a convertible note so that a borrower could come into a mortgage operation, could close on a single loan, have the funds necessary to either buy and build or to build on property they already owned, and at the end of construction it automatically converts into a permanent mortgage for the long haul.
Awesome. And so what are the key benefits of the construction perm loan for those wanting to build from the ground up?
Yeah, so the most noticeable benefit that a lot of people have is that it's easier to get. Banks have a whole different regulatory environment they have to deal with, which makes getting a loan outside of that structure often very easy, or I would say a lot easier. There's certainly the cost savings of having one closing for the construction perm loan instead of having two for the construction perm loan or the construction loan and then the permanent loan. But there's also a lot of flexibility now that is unique to the mortgage process that you really don't find in like a construction loan. And the one thing I will tell you is that the construction perm loan is allowed to use mortgage underwriting guidelines and program parameters as opposed to being subject to the whims of what the bank feels like they want to do based on their subjective feeling for like who they feel like you are as a credit risk.
Gotcha. So with that in mind, are there specific credit requirements or down payment options or conditions for this particular type loan?
They're right. There absolutely are. So the program that a lot of banks have is a portfolio program. And remember, portfolio means that they're going to lend their own money, both for the construction and for the permanent loan that is serviced. That's what's available in the jumbo market.
Okay.
And it's available with some customization on certain products as well, which I'll tell you about in a little bit. The portfolio program really is a credit score requirement of a 700 currently. All this is subject to change, famous bank disclosure, of course, with a 43% debt-to-income ratio limit.
Okay.
Whereas, and that loan program goes up to $1.5 million by program, and it can go up to in the millions by exception, just based on the client's needs, their overall profile, back to more of a subjective look in terms of whether the bank wants to take on that level of a credit risk.
Nice.
So there's portfolio, there's conventional, which is then product that's sold to Fannie Mae and Freddie Mac at the end of the day, and that has a 680 credit score requirement with a 45% debt ratio, and those loans go up to the conforming limit of 726,200. And then finally, something that is really awesome and exciting about Ameris Bank is that we offer the FHA solution. The FHA solution is amazing because it offers the borrower a 3.5% down payment. It offers them a 640 credit score, up to a 50% debt ratio, and the seller or the builder developer, if they're buying from somebody that's building developing, can actually get into that loan where the builder developer can give a 6% seller concession, meaning that in that case, that customer can actually get into a down payment only type of transaction.
Wow.
Famous disclosure, I got lots of disclosures for you. The FHA program, the conventional program, and the portfolio program, we offer these out with guidelines that we use as the parameters that we use to pre-qualify people for these loans. But the files have got to receive a qualified automated underwriting approval every time in order to make sure that we have a deal that is
Solid.
suitable and marketable.
Okay, awesome. So with all of that in mind, what type of interest rates could a buyer expect with the construction perm loan?
Yeah, so the interest rates for the portfolio program currently are somewhere in the low sevens. Those are available on 7 and 10-year ARMs, 5, 7, 10-year ARMs. The conventional and the Fannie Mae has a very interesting interest rate product because it floats with the market. At Ameris, we currently and customarily will determine the interest rate for a construction perm loan by taking a look at what the current fair market rate is for a traditional purchase loan.
Okay.
During construction, we'll add a 1% to the rate. That's their locked-in rate. Nothing can ever change. But what's nice is at the end of construction, the borrower has a chance then to float back down to the conventional purchase interest rate, which if rates change, they would pop up by 1% during construction and pop right back down. Fortunately, currently, this is August of 2023, we've got the projections at least that show us the potential over the course of the next 9 to 12 months of a declining interest rate market, if we ever get there. And in that case, whatever that lower rate is at the end of construction, they'll be able to float down to that rate.
Awesome.
Yeah.
And I'm sure that'll help a lot of people with making this decision. So how does the draw schedule work with the construction perm loan, and how can clients ensure a smooth payment to their builder or whoever?
It's a great question. The draw schedule is part of a larger sort of process. So let me touch on that for just a minute.
Okay.
When a person comes to us, construction perm loans really do take one of two forms. Either you're doing a purchase style construction perm loan, or you're doing a refinance style construction perm loan. The difference being whether you own the property at the time you close on your construction perm loan or not.
Got you.
If you're purchasing the lot at the time that you actually close on the construction perm loan, the value of that transaction is considered to be the lot acquisition cost plus the cost to build. So if you've got a lot that they're paying $50,000 for and the cost to build is $350,000, you've got a value of $400,000. So if they're going to get into a 3.5% down or 5 or 10 or 20% down, it's off of that $400,000.
Got you.
In the refinance scenario, even if they purchase for $50,000 and say they've got a $37,500 lot loan that they have to pay off, the construction loan can be for the cost to build and paying off the lot loan. But because this is a refinance type deal, two things that are important are able to happen. One, I can roll closing costs into that loan. Also, I can now, instead of using the cost basis of $400,000, I can use the appraised value to determine the loan to value, so the borrower gets to take advantage of the equity that's created from the transaction.
So essentially, they're getting the equity up front, if you will.
They are, and they're able to use it in order to be able to get better terms in the form of an interest rate. And quite often, if they are able to achieve an 80% loan to value, they'll walk into their deal with no more money out of pocket.
Okay.
Okay.
So now, if they own their land already outright, no loan or anything on the land, are they able to participate in this loan program?
Yeah, that's the refinance style.
That's the refinance
They
style.
can have a loan or they can own the property outright. It doesn't matter.
Wow.
And the cost structure of these deals, I'm going to drag us over to your question about the draw schedule. The cost structure of the transaction looks a lot like a regular old purchase loan. The differences being that because we do both the portfolio loans and the FHA loans, and the FHA loan by design is meant to service someone that does not have a greater sense of wealth per se. We pack in a lot of the potential possible fees that a person could face at the end of this process if things don't go the way we want them to go as deposits up front. So we've got a lot of safeguards in the Ameris Construction Perm program. The only extra fees are a modification fee and a construction loan fee.
Okay.
We also don't set up the escrow account for the permanent loan until modification. So what's interesting is because then there would be cash needed even though there's no closing costs, there would be money needed at modification for the permanent loan. Those deposits are already there, and most of that money is already waiting for them, so they can work out into the permanent loan without really having to find more money at the closing to set up the escrow, pay prepaids, and that sort of stuff. It's really nice.
Yes, I agree. So let me ask you this, with the loan type and everything, are there any restrictions on like architectural style that they can build, or location, or anything like that?
No, the only thing that we are mindful of is making sure that if you're building in a subdivision, that before you start the process, that we've got HOA approval for what you do want to build.
Gotcha.
Outside of that, you just need to meet the codes for what it is that you're actually building.
Nice.
And the permitting and that sort of stuff, that can all be built into your actual budget. So even if you're paying for it out of pocket, it's possible to have those line items in there so that when you take your draw, you can take a draw and put that money back where it came from, because we want you to be as strong of a borrower as possible when you go through the process.
Right. So can you walk us through like the application and approval process for the construction perm loan? Like, where would my buyer, if I have a home buyer who is ready to go and says, Meg, find me some land, I want to, what's the process?
We always tell everybody that will listen to us, before you go buy land, before you go get under contract to build a house, get pre-approved.
Absolutely.
Pre-approval process is the same as a purchase. We will collect credit information, ID, income, assets. We'll talk about your level of affordability, what your other obligations are, your capacity to be able to carry off the transaction while staying financially healthy. I can tell you that a lot of people that are doing this outside of a subdivision or outside of a controlled environment, we oftentimes, depending on whether or not one of their core goals might be to lay out as little cash as possible for their transaction. In which case, oftentimes we recommend that they get a lot loan first to acquire the lot, and after the lot is under their control, to do the refinance style so they can take advantage of that equity that's created from the transaction. That creates two loans, that creates two closing costs. We're not trying to, pull one over on anybody. We're just simply saying that sometimes, and I can give you a demonstration if you like, but sometimes you can actually have a scenario where a person can put very little money out of pocket in order to acquire the lot, and oftentimes that's the last cash out of pocket they have to bring.
Got you. Okay. And then, and yes, we can do the, I just have one other question, and then maybe you can do a demonstration of how those different options work. What safeguards are there in place to protect the buyer, like during the construction phase? Shoddy builders or whatever?
That's such a great question. The entire process is so protected because while we're building your home, Nick, we're building the bank's collateral. So we have a process that we brought up that we never did get to, which is the draw schedule. The first thing that we do as a line of protection for the borrowers, make sure that they're approved and that the strategy that we have for them as foundation is financially sound.
Okay.
That's the first start in anything we do.
Right.
The second thing that we do is that we actually do have a builder approval process here.
Okay.
So that when people want to build with somebody, we will take a look at their credentials, at their capacity, and their experience, and we'll make sure that this is somebody who's in the business of building homes.
Right.
A lot of people have a builder's license that actually don't build for a living. They use that license as a credential for other things that they have, and all of a sudden they want to build a house, and they decide that they, because they've got the credential, that somehow that they're qualified to build homes, and that's not the philosophy that we follow at all.
Okay.
The third thing is that during the course of the third thing would be that you come to the table with a builder who has proposed, whether you're paying off land or you're on the land outright or you're buying the land, doesn't matter, and you've got this cost to build, we will make sure that the after completed value of the home, regardless, is equal to or more than what you're actually spending on the transaction.
Right.
We won't let you get into this process with being upside down on the loan without your knowing it.
Right.
Because of course, if the transaction that you're trying to get qualified for has an appraised value of $400,000 and the cost that you have is $410,000, you can still close the deal, but you'll have to bring that extra $10,000 to the closing because it's not covered under the loan.
And which was going to lead me to another question that I actually just thought of, that I didn't put in my notes, but for instance, because I've, sold obviously in, developments, like a Pulte development or something, where people decide, okay, I want to add on, I want to upgrade the cabinets, or I want to upgrade the flooring, or what have you, or whatever. And some builders will ask for those upgrades to be paid up front, and some will allow you to roll it into the loan. So how do you tackle something of that nature?
That is a great question. Let me get to number 4 on the previous question, because
Okay.
your question is right on the mark.
Okay.
The 4th thing is the draw schedule, which we've taken a minute to get to. When you are building a home, your budget will be divided out into about 20 different line items. Your builder will complete 1, 2, and 3, or 1 and 2, or 1 through 3 and 4, and they will request some money from the loan so they can pay their subs and take some profit.
Right.
The bank will send an inspector out to the house who will take lots of pictures. We'll make notes of the 4 things that the builder is representing have been completed, making sure that they're 100% complete, that they've been done correctly, and that they're good to go.
Okay.
And the inspector will approve those 4 items back to our construction department, who then will release only that portion of the loan to the builder. So we always have the builder doing work before getting paid for what they've done. And in the event that you had a draw request for 1, 2, and 3, and our inspector appreciates the fact that only 75% of item number 3 has been complete, they'll release 100% of the money for number 1, 100% of the money for number 2, and 75% of the money for number 3. So we don't get upside down against that builder.
Nice.
All right, now back to the question you just asked. So when you are buying a home into a subdivision, you don't actually do the transaction until after the home is built.
Correct.
If you fall out as a buyer for any reason whatsoever, the builder's stuck with that house.
Right.
The likelihood that they would be interested in making any changes for you and customizing your home are very, very low, because they need to sell that home to somebody else. So the idea that you had for putting pink and green shutters on your house, or having some sort of an elaborate, unique kitchen, is not really something that the builder would be interested in, because if you don't buy that home, they still have to sell that home to somebody else, and they don't really want to do anything that's too awfully unique.
Right.
With a construction perm loan, it's just the opposite. You are designing the home, you are finalizing the budget for what it's going to cost to build, and you are closing on the construction loan, and you already own that land, and you have the funding necessary to build that home on day 1. So there's no reason why anybody wouldn't go, okay, well, what size do you want your pink and green shutters, or how weird do you want the kitchen, because it's your home.
Right.
As long as you're meeting codes for safety,
Okay.
as long as you're meeting the codes for either your HOA or the city or county, wherever it is that you live with regard to what you're building, you can build whatever you want to.
Okay. So this sounds like a great option for someone who is, say they're in an apartment or whatever, and they're not liking the options that they're seeing when they go look in downtown Alpharetta, or when they look in, it's kind of hard to find a home in Buckhead these days, single family anyway.
Yeah.
But wherever they go look, we can go find you a lot, and you can build your home where you want, how you want. That's the true concept.
And something that's often very much overlooked is the idea that you don't always have to build a new home on a raw piece of land. Every one of these lots in the greater metropolitan Atlanta of our 8 million people, most of them have a house on them. Some of those houses are in disrepair.
We could do a tear down.
Some of those can be torn down, and if you need to buy a lot then for $250 and spend a couple $100,000 building a home, and it might be worth your while with regard to what it's going to be worth after the fact, that's a very common way of finding a lot in the Atlanta market.
So, but then we get into demolition cost, obviously. Would those demolition costs be something that can be rolled into the loan?
Yeah.
Nice.
Yeah, sure can.
I like it.
Yeah.
All right. Well, I think we can go ahead and do your demonstration
Sure.
on the loan types.
Sure.
Say the purchase style versus the refinance style, which would be the refinance style is where they already own the land, and the purchase style would be where we're buying everything
Yeah, so what we talked about was where one of the core strategies that people come to me with is wanting to actually get into their house with as little money out of pocket as possible, okay? So whip out your calculator, because I'm going to have you do a calculation or two if you don't mind through the process here. So we're going to start off with the purchase talk, because this is what everybody always kind of understands. And that is let's do a $75,000 lot. Let's do a $425 cost to build. Sorry for my chicken scratch. That gives us a cost basis on this transaction of $500,000. Let's say that this person wanted to get into a scenario where they put 10% down. For what reason, we've got no idea currently. We're just talking about a 90% loan. To achieve a 90% loan to value, 90% loan to value, that's right. That would be a $50,000 down payment and a $450,000 loan. And we would have closing costs on this transaction, I would say, somewhere around like maybe $10,000. So the closing costs of $10,000 means that our total cash out of pocket, let's call it cash out of pocket, is going to be $60,000. And now they are in this process and they've used money and they're in a 90% loan to value. And a lot of people are perfectly fine with this as a loan strategy for building their home. A lot of people have anticipated that they need to save up money to do this process. Not everybody's thinking that there's a different way to do it. But let me show you what that looks like. So if we're over here with a lot, let's do the lot scenario of $75,000. And we're going to get a lot loan of 75% of that, because we have a 25% down payment requirement on the actual lot loan. I think this comes to $52,500. $56,250. Okay, as a lot loan. We're going to roll in then also the need to build still with the cost to build is $425. I use cost to build as a total thing. Cost to build of $425,000. And so that is $481,250. Okay. We also have closing costs of $10,000. So we have a total need of $491,250. Take that $491,250 and divide by 0.9.
0.9 or
0.9. 560. Yeah, divided by 0.9.
545, 833.
45, 843. So 833. Yep. If this house that we're building appraises at $546,000, then this entire scenario holds. They've got the lot paid off. They've got the cost to build fully funded. All the closing costs have been rolled in there, and they're also still in a 90% loan to value, just like over here. The only difference was our ability to use the appraised value when determining the loan to value that determines their equity injection. So in this transaction, the total amount of money that the borrower brought out of pocket, what's 25% of, is it $17,750 or something?
It is 15,000.
$15,250?
Make sure. 18,750. I'm sorry.
18,750, and let's call it like 2,250 in closing costs. So their total out of pocket here was $21,000, and over here their out of pocket was $60,000. So the truth is that when we have the opportunity to buy the lot first, and when the core objective of the borrower is to have minimal cash out of pocket, this is a great strategy for us to use.